bring in our
proper introduction.
Our distinguished guest, because I'm going somewhere. Our distinguished guest host this morning, former Dallas Fed President Richard Fisher, currently pulling down some huge dough as a senior advisor at Barclays and as a CNBC contributor. The reason I was going to ask
that's where the dough comes from.
The reason I was going to mention is that you're not buying into a rate cut because you think things are going well. And I was going to say this. Don't talk about Texas, because Texas is not, and don't talk about your own bank account, which is obviously going very well. But so, yeah.
Aren't you glad you came in?
Yeah.
You think that this
introduction.
You think this dot plot? You think that they're just wrong? It's just wrong, and Richard Fisher is right.
Well, first of all, rates have come down. I don't understand this business the Fed has to cut. The Fed does not determine the shape of the yield curve. Markets determine the shape of the yield curve.
Right.
I just came back from London. I met with all the largest asset managers there, and they're piling into dollars, Joe, unhedged, which is really a change from the end of the year, beginning of the year, where they said it's too expensive, I'm going to hedge my position.
And it's just the best house in a bad neighborhood. That's all it is, right?
Well, the old joke, right? Best looking horse in a glue factory. But we're not. We're Secretariat compared to everybody else. We have nominal yields that are positive. And by the way, it's a self-fulfilling prophecy. You pile in and look at the dollar index.
That's the reason people are saying the Fed should cut. Is the dollar is too strong. You want to weaken the dollar.
So we're currency.
I know, but that's good for the S&P. My point is, rates come lower because there's more demand relative to supply. Look at the 10-year. These guys are piling into the 10-year.
They're beating us in Europe. I mean, ever since the Fed got patient,
they got
the dollar still. The euro's 111 now.
And I'm convinced
nothing has happened since the Fed backed off. I mean, you would have
if the Fed were to cut here, it would just encourage this movement further into dollars, in my view. People are hungry for some positive nominal yield. The rest of the world is a frightful place, and people here don't want to go put their money in those frightful places. Who wants to be in Europe? Where else are you going to go? Japan? You're not going to go to Japan. The EMs, there's only so much you can do, and you can trade those things. They're always disappointing long term. Mm-hmm. So I just find essentially, Leo Brainerd, the governor, the Board of Governors of the Federal Reserve, made a speech today, yield curve management. She noted you can't go out much more than 1 or 2 years to affect the yield curve. The market determines, in my view, the shape of the yield curve from 2 years on out.
Yeah, right. That's what Rick said this morning, too.
I mean, Europe,
Someone else said this? Oh, my gosh.
I'm not sure what Europe needs to do. I mean, I was just looking at, I was just reading Netanyahu. I thought he just won. Okay, so they dissolved parliament because he can't form a coalition government. Then I just looked at the EU elections, and I'm looking at the way these other countries run their governments. Why don't we license out the Constitution in all these places and say, look, you can use our system over there. Here's what you do. We won't even charge much for it. But, I mean, are not these other forms of government insane? Are they not insane? How many
globalization is, Joe?
How many prime ministers?
That's what we were doing.
How many prime ministers?
Until a certain president decided globalization was not a good idea. We were running the world.
Why don't they just take our system and
All I can tell you
globalization is.
Right now, we are the sweet spot of the global economy. We have positive growth. I notice you're going to focus on manufacturing. Manufacturing is important, but it's 11% of our economy. We are consumers and we're service-driven. And right now, according to consumers,
it's going to come down a little bit. It's coming down a little bit. There's one report I read. I'm sorry to cut you off, Richard.
That's right. You've been doing this for years, so that's okay. Go ahead.
Yeah. I have been listening patiently. I've been patient. There's one report I read that said it may come down more than we expect because, look, the big swing factor that caused it to be much higher in the first quarter and could cause it to be lower is inventories. Nobody really knows how to estimate inventories. We sort of make it up.
The build could have been because people were trying to get ahead of anything.
Ahead of the whole
getting ahead of the whole China thing, right?
But Becky, I just want to come back to the question here, which is my report was about this. And maybe I should have been more clear. Sorry. Is what's driving the market now what do you want to call it? The temporal issue right now of just the trade talks? Or is there something weaker brewing in the U.S. economy the Fed needs to respond to? Because I think the thing the Fed fears most is responding to a trade talk problem that goes away with a call from President Trump to President Xi. And then all of a sudden they've cut rates. Or, and this is, I think, a legitimate question, is the yield curve telling us something is more sick about the U.S. economy?
That's what you're trying to figure out.
Right.
Because they care about the real economy. Can I just point out one historical fact here, by the way? Talk about the yield curve. The term premium, according to the New York Fed, is the lowest since 1961.
Why don't you explain what that is, Richard? Not everybody knows.
Well, in other words,
What you pay for more, right? Just to
you're not picking much up. You pointed that slight inversion. So it's the lowest since 1961. We had a sell-off in 1962. The market was down 27%. The economy was still strong. The economy did not weaken. Remember, you had the Kennedy tax cuts and so on.
Why did it sell off?
Markets sell off. I mean, sometimes it's inexplicable, but the point is the economy continued to perform. It almost performed for another 10 years.
Well, that's a scary comparison.
Well, I'm just telling you.
So does the market have this wrong, Richard?
I don't know.
Is the market way ahead of where the Fed is?
My point is the market,
because they got 3 cuts rated built in for next year.
Well, we'll see. But I think the Fed will always respond to the real economy. And they have to do it with, as you know, in advance, because there's a lag for monetary policy, although now you get instant response in the markets. The consumer numbers look pretty darn good still. Confidence looks decent, at least what we got from the reports last week. So we're going to have to take a look here and see, and they're going to have to determine whether or not the economy is actually weakening or not. I don't think the first quarter growth numbers are going to tell you very much. They're focused on what's going on now and how they see the future. And I don't believe they're going to respond to the markets. The nice thing about this, President Trump could not blame the last sell-off on the Fed. It was China, China, China. That was his own doing. So maybe he'll lay off a little bit. And even if he piles in on the Fed, I don't believe it has any influence whatsoever. And it shouldn't.